we have today an absolutely interesting research seminar on the effects of financial inclusion on food security, bringing together two strands of literature, the huge literature on financial inclusion that we've been touching on for some years now within this medium of the Center for Global Finance, but also introducing another important literature on food security, which is risk number 3 globally. If you take the global risks like COVID-19, and then you take climate risk, and then comes in about number 3, food security risks on the global dimension. And so the researchers bring together in a novel way these two strands of literature, and then they test plausible models with insights, specific insights from Nigeria, I think one of the largest countries in Africa. But it's a pleasure to introduce the main presenter today, who is our very own Dr. Ayse Demir. Ayse perhaps doesn't need much introduction to you because I think most people here in this meeting have known Ayse for some years and met with Ayse either virtually or person to person. She is a person that is very quickly making a huge amount of impact on research and trailblazing and having a very, very rapid rise in terms of her research career. Just only a couple of years ago, she was with us here at the Center for Global Finance and at SOAS University of London, as indeed the first postdoc research fellow in the center. So she's a pioneer in that regard for the Center for Global Finance, and was working under the inclusive finance projects at SOAS University of London here during 2017 to 2020. And she then moved quickly and took up a full-time lectureship in economics at Coventry University. And then, very quickly cutting through the promotion, moved as a senior lecturer now in economics and finance at the University of Roehampton. And her work has cut across a number of areas, including, financial economics, development economics, institutional economics, focusing on issues like financial inclusion, financial technology, fintech, and always comfortably playing around with the huge databases. And in terms of her background, she took her MSc in economics and her PhD in economics from University of Leicester in the Midlands here in the UK. So it's very great delight to have Ayse sharing with us her very interesting work. And with those just the amount of words, I'll call upon her. But before I do that, let me remind ourselves that if you could please switch off the microphone just to shut off some background noise, but also to encourage you to send your feedback, comments, questions in the chat, or save them. And after presentation, we can enter into the mode of cut and thrust and feedback, discussion, and be interactive, because I can see this is ongoing work. And one of the greatest benefits of this research work is sharing through the medium of these Center for Global Finance seminars, is to rapidly enhance the quality of the work with suggestions before Ayse and her colleague can subject the paper to those recalcitrant referees from high-rated journals. So Ayse, in fact, when we talk about research impact, you have demonstrated already research impact from the way you have had a big impact on the Center for Global Finance, and then now sailing through your career to this level. So it's a great pleasure. Well, let's put our hands together and welcome Ayse's presentation. Ayse.
Thank you very much, Professor. Thank you very much for the kind and broad introduction. It's always a big pleasure to be part of this organization. And of course, thanks for giving us this opportunity to present our research output here, where we are able to get feedback from high-profile scholars. And it's such a pleasure to be here today. And good afternoon, everyone, and thanks for joining this presentation today. And today I will be talking about our joint paper with Joseph Ajefu. Dr. Joseph is a senior lecturer in economics at Roehampton University. The title of our paper is The Effects of Financial Inclusion on Food Security, Evidence from Nigeria. It's a case study from Nigeria. So this is a work in progress, like how highlighted. So any comments, suggestions are very welcome. Previously, we submitted this paper once to a journal, and one of the feedback that we have received was on the instrumental variable that we have used. So especially on this respect, your comments will be highly appreciated for your suggestions. Okay. So this is our brief outline. We are following a traditional structure of outline, and we will start by introducing our background, which includes motivation and our contribution. Then I will discuss literature review, empirical literature review, and the theory. After that, we will go through data and model. I will move on by discussing our empirical results, and then finish by concluding remarks. And the second agenda of United Nations Sustainable Development Goal is to end hunger and achieve food security by 2030. However, recent evidence shows that the absolute number of undernourished people in the world has increased from around 800 million in 2016 to almost 821 million in 2017, and 2020 this is between 720 to 811 million, where people face hunger. The prevalence of food insecurity is higher in Africa compared to other regions in the world, and about 256 million people in Africa, which accounts for the 21% of the population, suffered from chronic food deprivation in 2017, and currently 264 million people in sub-Saharan Africa were undernourished. Hence, food security remains one of the major barriers to human and economic development in the region. Against this background, the question of how to guarantee adequate food security in a sustainable manner for the poor and vulnerable households in developing countries has often been on the front burner in many policy discussions. Of course, there is also a growing consensus that financial inclusion can improve households' economic outcomes. This includes also food security. And it may also provide sustainable pathways which ensure food security and reduce food insecurity in developing countries. First of all, we would like to open a bit about the conceptual definition of financial inclusion, as most of us aware, but just to have a recap. Financial inclusion means that individuals and businesses have access to useful and affordable financial products and services that meet their needs, and transactions, payments, saving, credit, and insurance that is delivered in a responsible and sustainable way. The existing studies focus largely on the effects of financial inclusion on income and poverty. For example, financial inclusion on household economic outcomes, and this may provide a sustainable pathway to household food security in developing countries, but not in specific focus on that dimension. Or there are another strand of literature which focus on the investment benefits of financial inclusion, which increase education, for example, children's education, or business startup and expansions, or cope better with better risks and financial shocks than financially excluded individuals. And this is especially the situation in developing countries, especially in sub-Saharan Africa. But although it's important, still many individuals and households in developing countries are financially excluded from formal financial institutions. And notwithstanding the growing evidence of the importance of financial inclusion, the debate on the causal impact of financial inclusion on economic lives of the poor in developing countries is inconclusive, and we have the special knowledge gap on the implications of financial inclusion for the alleviation of food security. So, how do we aim to fill this knowledge gap in the literature, and what are our intended contributions in this respect? First of all, our study focuses on Nigeria as a case study because it provides a compelling context to investigate the effect of financial inclusion on food security. This is because, first of all, Nigeria hosts one of the largest financial inclusion programs in Africa. That is National Financial Inclusion Strategy, NFIS, that is promoted by Central Bank of Nigeria. And secondly, Nigeria is one of the countries that accounts for the highest number of people living in extreme poverty and the number of people undernourished. And to the best of our knowledge, this paper is the first to examine the relationship between financial inclusion and household food security at the micro level in the context of Nigeria. And we are also using a multidimensional index of financial inclusion, which considers the dimension on the ownership of formal bank account, credit from formal institutions, the use of credit from formal institutions, and formal insurance to investigate the effect of financial inclusion on food security using an instrumental variable framework. What is our approach in that? We adopt an instrumental 2SLS approach to address the endogeneity associated with household financial inclusion decision. And to obtain instruments, we use two-stage list squares, and we merge actually the household survey data with the georeferenced data on financial services points obtained from inside two impact I2I GIS interface. That would enable us to determine basically the household's distance to the nearest financial institution. It is kind of a proximity measure, which measures proximity of each household to the nearest formal financial institution. And we use this variable as our main instrumental variable to instrument financial inclusion. Actually, the choice of instrument is based on the previous studies, which argue that distance to financial institutions is one of the major barriers discouraging people to benefit from financial services and products on a regular basis. Therefore, being financially excluded is driven by barriers in terms of distance to financial services. We also identify potential pathways through which financial inclusion affects household food security in our study, and these pathways include receipts of remittances, household income, wealth, or asset accumulation. We also investigate the risk coping or mitigation impact of financial inclusion on households' exposure to drought shocks using various indicators of food security, such as food access, food utilization, and food availability. The mitigating role of financial inclusion is analyzed using rainfall to construct drought shocks. And so we find that financial inclusion actually plays a mitigating role on the effect of drought shocks on household food security, but we will analyze this more in the empirical section. Yes. Figure 1 actually summarizes the potential pathways through which financial inclusion affects household security. This is our theoretical framework, which we derive from the existing literature to put together all the pathways through which financial inclusion may affect food security. This includes the channel of income, investment, and consumption smoothing. So financial inclusion contributes to an increase in food security through income, investment level. So it is expected that financial inclusion will lead to an increase in the household income level that promotes purchasing power and economic access to food with direct outcome on food security of households. In agricultural areas, an increase in financial inclusion in the form of credit access for entrepreneurs is expected to improve agricultural output. For example, credit supplied to farmers help them to afford labor-saving technologies, and this leads to an improvement in the productivity and then income. An increase in production due to an increase in access to credit lead to an improvement in food availability, income, and of course economic access to food. Another potential pathway that financial inclusion can promote food security is the consumption and consumption smoothing, an improvement in consumption smoothing. The individuals in the lower income group do not only deal with the challenges of low income, but also their incomes are exposed to shocks from risks like death, illness, and business failure, which exceedingly affect household production and consumption decisions. So the high potential in the access to and use of credit facilitates individuals to tackle with these shocks without reconciling the production and consumption decisions. So in these three pathways, financial inclusion may stimulate food security and increase the economic welfare. We analyze the literature review on the relationship between the financial inclusion and food security. So this link has been investigated mostly on the micro level, analyzing the impact of microcredit on security generally, and the results are, conflicting results. So some of them suggest that there's a positive relationship, some of them suggest that there's a negative relationship. So some of them suggest that there's no significant relationship between financial inclusion and food security. For example, evidence by Atasano 2015 showed that an increase in food expenditure of individuals in Mongolia who use microcredit to set up business, there is a positive association, while Augsburg 2015 found a decline in food expenditures of individuals who use microcredit to set up their business. A number of evidence also shows a positive relationship between household food consumption and borrowing, women nutritional status, and nutrition of children. On the other hand, for example, Brett find that food consumption of borrowers declined due to the burden of loan repayment. And in the same line, Crebonet will also find a reduction in overall consumption among the borrowers who have pre-existing business, as they made more investment into business activities, yet the borrower who have not pre-existing business experience an increase in food consumption. So this is also a contradictory result. In addition, research also shows that excess borrowing and inefficient investment may lead a reduction in consumption in order to cover those losses. And further to that, a growing number of studies show that consumption smoothing created by these money borrowing significantly contributes to close gender gaps in food consumption, some of which show that food consumption of female borrowers is higher than that of males. And on the other hand, some of these studies have reported that an increase in borrowing has not been associated with a change in consumption level. So from the empirical literature survey, we see that the evidence is conclusive with respect to the implications of an increase in the inclusiveness level of financial system on security, which calls for more evidence in the context of developing countries. So we would like to first talk about our data. We use 2015 to 16, the third wave data of General Household Survey, GHS, that is a part of Living Standard Measurement Survey, integrated survey of agriculture project of World Bank. The GHS panel survey was implemented by Nigerian National Bureau of Statistics, NBS, with support from the World Bank. And the different modules of this survey data questionnaire provide information on the socio-demographic characteristics of the households and individuals, attributes for around 4,600 households. And we also use some other data from this database, such as information on access to formal financial services, food security outcomes, community characteristics, and other variables that we use in the study. We also use georeferenced data on households financial service obtained from GIS inside to impact. And this data allows us to exploit within districts and between household variations in proximity and density of financial institutions. And so we are able to measure the proximities of households to the nearest financial institutions. What we have done, we actually merge the GHS data with I2I, GIS interface georeference data, using the coordinates of two data sets. We use the coordinates of two data sets. And the combined data allows us to investigate households' proximity to financial services points, and we use distance to the nearest financial institution as an instrument in the instrumental variable and as adopted in this study for financial inclusion. So let's have a closer look at our financial security indicators. Actually, we adopt a comprehensive approach to measure household food security outcomes. And as proposed in the literature, this approach follows a multidimensional food security definition, which focuses on food security metrics or indicators such as food availability, food accessibility, and food utilization. And our first food security indicator relates to the food accessibility. Basically, we use per capita food expenditures as our food accessibility measure. And this measure is obtained by dividing household food expenditure by the household size. The second indicator we use focuses on the food availability in terms of quality and quantity of the foods consumed. From survey questions, the nutrient stock is considered for the number of days households reported to have limited the variety of food consumed in the last 7 days prior to the survey. So I would like to take attention to the definition because it actually refers to the limit to the variety of food consumed. The third indicator, we consider household response to food availability with regards to the quantity of food consumed. The nutrition stock is defined as the number of days the household responded to have limit. Again, this is unavailability. When we, although the concept is food availability, we measure it in terms of limited food availability. So the nutrition stock is defined as the number of days the household responded to have limit the portion of meal eaten in the last 7 days prior to the survey. So food availability is measuring quality and quantity of the food consumed, but it's in terms of limit, they limit to access these food. We also consider food utilization as another categorization for food security, and under this we have household dietary diversity, HDD, of different food group categories consumed by the household in the last 7 days prior to the survey. We also use food consumption score following World Food Program guidelines. We include both household dietary diversity and frequency, and actually we measure food consumption score by taking the weighted sum of the number of days household consumed food from 8 food groups. This is a measure from dietary diversity, HDD, in the last 7 days prior to the survey. So we also measure their frequency of using these dietary foods. So we have actually in total 3 dimensions: accessibility, availability, and utilization. Finally, we adopt a multidimensional financial inclusion index similar to Zank and POSO 2019. Financial inclusion index captures 3 dimensions: financial inclusion, which includes ownership of bank account, access to credit and loan, and access to insurance. And yeah, these are our security and financial inclusion areas. So we use the following model in order to conduct our empirical estimations. So the model for 2SLS estimation is follows, where HJ is the household food security indicators for households, availability, accessibility, and utilization, as we discussed in the previous slide. So this is our dependent variable, where our main independent variable is financial inclusion, which is a measure of financial inclusion for household. And we have a regional dummy variable included in our model that controls for unabsorbed regional level fixed effects. And standard errors are clustered at the household level. So beta actually gives our estimate on the impact of financial inclusion on food security. However, the estimates of B is likely to be endogenous due to omitted variable bias. For example, in some cases, financial inclusion and household food security may be correlated with omitted or unobservable factors, which may lead to bias estimates. And this bias may also arise due to likelihood that financially inclusive households having enhanced food security status. And moreover, more food secure households are more likely to be financially inclusive, and this can lead exotic and diverse diets for the households. So, but using 2SLS IV regression approach, B is the parameter of interest that captures the causal effect of financial inclusion on household food security status, where in the first stage of the regression, for the impact of distance to the nearest financial institution on financial inclusion is represented as the modeling represented in model 2, where this is household distance to nearest financial institution. This is our proximity measure. And so we present the first stage results in table 5. In the next slides, we will show it. Yeah, so this is our model setting, and this is how we approach to the endogenous bias by instrumenting financial inclusion using proximity measure. So this is our first table. So the results of estimating equation 1 are provided in 4 using OLS regression. We consider different indicators of food security, which are food accessibility, food utilization, and food availability. From column 1 of table 1, using food expenditure as the dependent variable, we find that financial inclusion is associated with an increase in food expenditure by 22%. From column 2 to column 3, the results show that household financial inclusion is associated with an increased food consumption score by 3.84 and household diversity score by 0.41. Moreover, from column 4 and column 5, we find that household financial inclusion increases associated with a decline in the number of days quality food consumed by 0.24 and a decline in number of days quantity of food by 0.125. Remember, these were the limits, unavailability measures. And the results from table 4 is our baseline results, and as a result of endogeneity associated with the financial inclusion, for table 4, we are unable to make causal interpretation of the estimates from these results. Therefore, we explore the instrumental variable approach in the next table. Table 5 shows the results from using 2SLS IV approach, and from column 1, the results shows that household financial inclusion is associated with an increase in food expenditure by 35%. And in column 2, financial inclusion is associated with an increase in food consumption score by 67. And household dietary diversity increases by 8.2%. However, we find no statistically significant effect of financial inclusion on the two categories of food unavailability on nutrition stock, limit to nutrition stock and limit to nutrition stock in terms of quality and quantity. And as you see, we also report the results of first stage estimates, that an increase in proximity distance, an increase in distance reduces financial inclusion, which are in line with our expectations, because we expect that distance is one of the barriers of financial inclusion, so it has a negative financial inclusion. And we also explore the potential pathways through which financial inclusion can affect food security. From table 6, we identify channels such as remittances, household income and value of assets, and the two SLS estimates show that financial inclusion is positively associated with the receipt of the remittances, household income, and the value of household assets. Specifically, households that are financially inclusive are likely to receive remittances by 30 percentage points compared to non-financial inclusive households. Many households receive remittances and other forms of transfers from financial institutions, and financial inclusion is also positively associated with household income in our results, and also with the value of assets. And these results also confirm the results of the existing evidence. In table 7, we explore another pathway through which financial inclusion can affect household food security. We investigate the risk coping effect or mitigating impact of financial inclusion on household exposure to drought. That's actually negative rainfall shocks. The results show that an increase in negative rainfall shock reduces food security outcomes, such as food expenditure, food consumption score, and household dietary diversity score. In both columns, we observe a negative coefficient of negative rainfall shock the security measures. However, an interaction of negative shock, rainfall shock, and financial inclusion yields a positive coefficient for 3 food security incomes, which shows the mitigating role of financial inclusion on coping the shocks. And table 8 presents the results of split sample between urban and rural households. The results for urban households are presented in panel A, while that of rural households are presented in panel B. Considering the effects of financial inclusion on food security and urban cycles, we find significant financial inclusion on food consumption score, dietary and diversity and nutrition stock quality. For panel B, we find positive impact of financial inclusion on food expenditures, household dietary diversity, but for availability, we don't find any significant impact. And yes, so what are our conclusions? This study basically finds that financial inclusion is positively associated with household food security status in Nigeria. We use different indicators of household food security, such as food accessibility, food utilization, and food availability. Our study provides a detailed matrix of various indicators of household food security, and using the instrumental variable approach, we find positive and statistically significant effect of financial inclusion on food accessibility and utilization. But for food availability, we don't find a significant relationship with financial inclusion. Also, we identify potential pathways through which financial inclusion affects household food security, and these pathways are remittance, received income, and wealth or asset accumulation. The coping strategy and mitigation role of financial inclusion is analyzed using household exposed to drought shocks by using the negative rainfall measure. We find that financial inclusion mitigates the effect of drought shocks on household food security. So our findings have some interesting policy implications. The recent drive by governments of developing countries, especially in Nigeria, to enhance financial inclusion of households through access to and use of financial services and products is very important. And our results have shown that financial inclusiveness level of households can be an important policy for the reduction of household food insecurity. And this outcome can also stimulate the achievement of second agenda of the Sustainable Development Goals, which is ending hunger. And household food security, of course, at the same time, positively associated with the poverty reduction, and ultimately it benefits the overall economy and promotes the country. Yeah, that's all. The presentation, yes.
Let's give a round of applause to Ayse for such an interesting paper and presented so clearly. Yeah, absolutely interesting. Thanks, Ayse, indeed. And there are quite a number of elements of path-breaking work here. Of course, the first one being to bring together these two strands of literature and to motivate it using SDG number 2, which is a great imperative. There are many good attempts of trying to bring the literature together, reconcile the theory, and of course, one could even have continued to involve the information asymmetry arguments, financial market segmentation arguments, and food security issues, or even have a global-wide correlation, just a simple scatter diagram of the two elements of financial inclusion and financial security, and see where it lies. But I think the literature you have cited does highlight the controversy that on one hand, the prediction of the impact on food on financial inclusion on food security is positive at ANASU and others 2015, or it's sometimes a negative in Osberg and others in 2015, the same year. And then you go on to propose a plausible model, and the model allows you to specifically focus on those two elements, the two important relationships between financial inclusion and food security. I have a number of comments, but I will not abuse my position as chair, and it's kind of suggestions. Let me first call upon colleagues to make the observations. I can see, first of all, we have some interesting comments in the chat. So maybe let me first call upon Hongbo and Jaidip to share with us the comments, and then I'll come and see and call upon the participants that have had their hands up. So oh, actually in the chat room, no, my comments.
See the chat room.
Can you see you can't see the chat room? No.
I can't see the.
Okay, so I will call upon Vasileo, then Hong, and then Jaidip. Those three comments in the chat. So Vasileo, you can go first.
Yes. So it was very good presentation. I enjoyed that. Just a minor point, actually, I think it was table 5, where you had a few asterisks, but I think it was not statistically significant in model 1. Table 5, the next one with the IV, I think.
Yes. Can you
Yes.
Mm-hmm.
So I think the 0.352 should not be statistically significant given that standard error. That was the only thing I noticed that caught my eye.
You mean based on the t values?
Yeah.
Okay, let me take a note on that.
Okay, thanks, Vasilis, and
You're welcome.
we'll go back and have another look at that. So, Hong.
Yes, I'm sorry. I'm busy in preparing to leave for my teaching, actually. So my question is, Ayse, thank you very much for always very simple and clear presentation. But my question is on the IV. So I wonder whether or not the geographic distance to any financial institution can say something about, or can say that much about financial inclusion. For example, if I have a digital mobile account or something, so I do not need to go to my bank. I have not been my bank maybe for 2 years now. So have you considered this? If you insist, or if there are some references based on which you argue, this is a good IV, but you need to test them. So you need to have, as far as I remember, there are 2 tests that are relevant. One is you need to test whether or not this IV is external. Yeah. And the other one is the common test. So I forgot the name, but there are different tests on the IV. So I think you may need to look into them to convince people that the IV that you are using is a proper one.
Mm-hmm. Yes, thank you so much.
And thank you.
Thank you so much.
And thanks very much, Hong, for your intervention and the contribution before you go to take your the lecture. Jaideep.
Hi, Ayse. Thanks for that presentation. Thanks, Victor. I really enjoyed. I think the idea is great in terms of the financial inclusion being sort of something that directly affects food security, or I mean, first maybe poverty, right? In a sense that this is like the most basic element. So from that point of view, I'm just trying to figure out with these particular measures of food security. I don't know the literature very well, but isn't food expenditure something to do with like just the cost of food? And if that is the case, then food prices go up when people don't have access to food. So they might be spending more on food, but the security would come from the idea of it not being a bigger proportion of their total income, right? So in a sense, you're thinking about the non-food expenditure and its share as being a more reliable idea of like what is food security, like in the percentages terms. And so that's why maybe this conflicting evidence you find in terms of increase in expenditure on food might come simply from the fact that the subsets of the population that you're looking at, some of them will spend more money on food because they'll stop spending on like clothes or something, and vice versa. So maybe a different type of sort of measure of food security might be like a thing to sort of resolve this what you're finding, this inconsistency in the in the other people's results and in some of your findings as well, for which reason you had to go for an instrument. And again, with the instrument, the same thing comes up. It's like if you think about where people are going to provide more financial services, that's pretty much going to be correlated to an extent with where people are going to provide more food shops or some other facility. If you're in a remote area, you will have neither. And if you're so food sort of food proximity, so I'm talking about availability literally in a physical sense, is probably correlated with financial proximity. So again, then it becomes a questionable instrument in that particular case, not in all cases, but in that specific case. So I just thought that these are maybe things to like finesse a little bit, but uh, if you address these, you probably will be able to resolve the debates that other people are like not able to resolve. So I think that will be great. Thanks.
Thank you very much, Jay. Yeah,
Nice.
these are very useful comments, especially your note on food security and financial proximity is very good to explore. Regarding the food expenditure, an increase in food expenditure associated with inflation, currently we are using household survey data only for one way, where we are not able to compare an increase in food expenditure per household in varying time dimensions. We can only compare food expenditure of different households, not the food expenditure of each individual household on changing time dimensions. If we were able to, if we have second or third way, we could also take into account inflation effect, but currently we can only compare the household expenditure of different households, which only gives us a measure of financial food access. But if we are able to take into account inflation by including more time dimension, then of course it will be good to refine inflation impact from the expenditure and see the real comparison of food expenditure among different households. Yeah. Thank you, Jaydeep.
Okay, thanks, Jaydeep. Absolutely useful feedback. I now call two hands up. One is Teresa and one is Jeffrey. So Teresa first.
Hi, thank you, Victor. Sorry, I also need to leave for a meeting now at 2, but thank you very much for your presentation. I also work here at SOAS, but in economics on financial inclusion as well. And I think your work is very interesting. And I can also write you later on some other suggestions, but I wanted more to understand a little bit the mechanism from what you explained at first on the consumption smoothing investment, and I forgot the first one. What was the other mechanism through which financial inclusion could improve food consumption? And because from my understanding, you have 3 components in your financial index, and remittances would be mostly related to access to ownership, and household income, potentially to microfinance, right, from loans. And insurance, I wasn't sure where insurance would fit in this explanation on the causal mechanism on how you can increase food consumption through financial inclusion. So maybe it would be interesting if you could elaborate a little bit more. Although I'm leaving soon, so maybe it's I can write you an email later on so we can discuss. Sorry, I have another meeting now.
Yeah, thank you, Teresa. Yeah, I think that's a very good point.
Yeah, thank you indeed. I think both of you will catch up and have a dialogue.
Regarding your question, consumption smoothing basically includes the insurance aspect of the financial inclusion, because as by the definition, you can see that the high potential in the access to and use of credit facilitates individuals tackle with economic and climate shocks without compromising production and consumption decisions. So actually, this is related with the insurance, although we didn't title it consumption smoothing, but it includes an insurance component within the measurement of insurance, financial insurance. So that's how we address. But like remittances, that's true. We have to fit the remittances in the mechanism that we provided. So it has to align with the theory. Yeah, thank you so much, Teresa.
Thank you. So I call upon Jeffrey.
Yes. Hello. Ayse, well done, and thank you for your presentation. I really enjoyed the paper, and also well done for having data for a study based in Nigeria, because it's very difficult to get data in that country. My comment is related to Hongbo's comment as well about the instrument, because I during your presentation I was sitting, trying to picture some villages that I know where you have to drive for almost 2 hours to get to the next financial institution. But in these villages, people have internet banking, they have mobile phone, and they all use financial services. So I was going to recommend you look at the internet infrastructure per 1 million people. It's data provided by the World Bank Development Index. I think that would be an instrument you can try to see if that work better than physical proximity to financial institution. Again, well done. Thank you.
Thank you so much. Yeah, that's very good recommendation. Infrastructure, internet. You said internet infrastructure, isn't it?
Yes, it's internet infrastructure per 1 million people. It's available on the World Bank Development Index.
Yes. Thank you so much, Jeffrey.
Yeah, thank you, Jeffrey, and also for offering some useful suggestions. Let me see. I don't seem to see any other hand up, but meanwhile, I give an opportunity for colleagues to come up with the suggestions and comments for feedback. Just let me go back a little bit to the development of the theory underpinning this important study. And you bring up very many interesting aspects of the theory. But I'm thinking of some of the predominant theories, say in financial economics, mainly the information asymmetry, transaction costs, which both of them combined tend to produce a financial market segmentation. So that the financial markets are segmented, and one group of people can get access to funds, and another group of people are excluded from access to funds. That's one interpretation of financial inclusion, resulting from information asymmetry, high transaction costs, and then financial market segmentation. Equally, in looking at food security, there could be a problem of access. Whether information about food availability is available, or whether there is a cost element. You bring in the interesting aspect of risk coping. I think I like that very much, because it allies with the fact that some household may be able to cope much better than others. But I was thinking if there is a way of bringing in this a financial economics argument of information asymmetry, transaction costs, and then financial market segmentation, and then to be able to bolster your argument that because some households are financially excluded, they tend to live in a perpetually in a to suffer from food insecurity or lack of food security. So that's a one comment in terms of the theory. My other the second observation I have is in your definition and measurement of both a financial inclusion and, yes, that's the slide. Yeah, that's the slide I was looking at. Absolutely very interesting aspects, very plausible, very credible, food accessibility, food availability, food utilization. They are all well entrenched in the literature. And then the measurement of financial inclusion of 3 dimensions. Now, when I look at the 4 dimensions of food security indicators, or the 3 kind of dimensions, I can identify the demand and supply side. So, food availability is, I guess, on the supply side element of food security. Okay, let me interpret food availability at the supply side of food security. When I come to financial inclusion, I cannot identify a supply side because ownership of a bank account is for the demand side, access to credit on the demand side, and access to finance. If there was cost, if there was the supply side would be the availability element of whether the financial institutions are generating enough loans or for households to be able to access finance. So I'm thinking just all that there is supply side on the financial security indicators, and I'm struggling to identify supply side on a financial inclusion. And then the other comment on measuring financial inclusion, yes, you make a very important breakthrough by having an index that has 3 dimensions, right? Now, I have 2 separate comments on this, actually, on this measurement. Comment number 1 is that how do we capture the cost dimension of financial inclusion? Because we know from the literature that some households are excluded from using from financial institutions or even financial markets because the cost is very prohibitive, high interest rates, high spreads, the measures exist. Okay. So that's number 1, the cost dimension. If it could, and maybe there are reasons why you don't include it. Then the second observation on this measure of financial inclusion is, yes, while on one hand it's great that you have a 3-dimension index. On the other, you sacrifice a little bit of detail, and the beauty or the devil might be in the details. Because when I look at the regression results you are sharing, you are actually able to go into the dimensions of food security. So you have actually explaining every dimension of food security. But we don't have the benefit of explaining. Maybe one could argue that it is one dimension of foods of financial inclusion, like access to credit, okay, or access to insurance, that enhances the relationship between financial inclusion and food security. But we can't do so now because we have an index on financial inclusion. I know it's a cheeky comment because basically, but not cheeky maybe because you could do a robustness test. And if the robustness test that says that all the 3 elements of financial inclusion have the same effect on food security, on all the 3 elements of food security, then you have a very clean finding to establish that really when there is a problem of financial security, we need always to think about, when we think about SDG 2 in some countries, especially in Nigeria, we need to think about whether we can resolve the problem of financial inclusion. Okay, I'll stop here maybe, and then yeah. Thank you very much. Yeah, Ayse, if you...
Thank you very much, Professor, for your comments. I take a note of all of them, and you are very right in terms of disaggregating the financial inclusion measures, and it's really worth to see their individual effects on the individual food security measures as well as the aggregate food security measures. This is a very important part because we see that financial inclusion doesn't have a significant impact on food unavailability. But maybe if we disaggregate financial inclusion measures, we may be able to derive more accurate conclusions. Maybe individual measures of financial inclusion may have varying effects on food availability. And also with other two dimensions as well for both accessibility and utilization. It may be, for example, insurance dimension of financial inclusion that has heavy impact on the food security rather than the two other measures, or the other two measures outweigh the effect of the security, the insurance. So yeah, this definitely, we have a disaggregated analysis of food security, and we have to also have a look at the disaggregated impact of financial inclusion as well. That's a very good point.
Yeah, clearly your paper is already very high quality, and I hope that you can target a four-star a journal. All these comments mean from these wonderful comments from Jeffrey, from Teresa, from Vasilios, from JD, is consistent with the paper that are coming from top tier journals. They have a lot of robustness testing. It's like you establish your results, and then you have to keep on making sure that these results are not accidental, that they are not subject to various covariates, various interpretations, various measures, that the index, even when you disaggregate in two parts, you still get the same results. So I suppose what we are much of the suggestion could be summed up to say, Ayse and Joseph, great work, but you need to do maybe some further robustness testing, and if your results come still, very strong and valid, then you have a great finding. The paper would be unique in the sense that it tries to reconcile two interesting areas of study. Yeah, great. Okay. Further comments, suggestions, observations? Now, I don't seem to have any further comments, observations. Let me check the chat. I think the last comment in the chat was by JD. Is that the same with you, Meng and Athena?
Yes.
Yes, and the hands up all existed, or exhausted. Yeah, but great, a great study, Ayse, and keep on doing this work and extending it into the robustness testing. The framework is very versatile. Use a single regression. It could also be done as a simultaneous equation system with both a financial inclusion and a financial security. And then you see the kind of interrelationship. It's one of the things that could be done in different ways, but you have the key important aspects. And if these results continue to hold, then you have something to feed into risk number 3 globally, which is the food security issue, and also maybe for extending this into a large project that looks at why food security issues impervious to policy changes. This is one of the questions being asked about SDG number 2. Why is it that there is a lot of policies being unleashed to fight food security, but it remains cantankerously stubborn. It's very cantankerously, existing in some countries which are suffering a lot of food security issues. Yeah, yeah. I don't know how high we rank Nigeria in terms of food security, but that's also maybe helpful in motivating the paper. If in terms of top risk countries, Nigeria is number one, that helps. But if it is number 100 or non-existing, that then the people might well, why are you studying food security in terms of are you taking one region where food security is very high? So the ranking of food security, this is a global one actually. On the AXA report for 2022, food security is one of the big risks. Yeah. I think there is a comment coming from Hongbo. I thought she was already teaching.
No. Yeah, I'm okay. I'm about to leave.
Okay.
So
Okay.
I just mentioned that if you extend the data
Yeah.
to the period after the war, so that you can see probably the story that you are trying to send out should be even stronger.
Yeah, I think that's
because we are talking about that, right? We are talking about food security. We are talking about the problems in Africa at the moment. And so, but that's only the suggestion because it depends on the data availability.
Yeah. And it may well be the case because even for some of these surveys, if the surveys are repeated surveys, I don't know, it's something you need to check very carefully because sometimes repeated surveys do not necessarily be repeated panels because the observations change every time they do the survey. But if there was something longitudinal, this work would be absolutely, exciting. Yeah. Okay, great. Do you have any further comments to give or a reaction to give Ayse before I give some concluding comments?
Thank you so much, Professor. Actually, this is very useful feedback, especially on theory from home and from the instrumental variable dimension as well, because this is the main part that we have been tackling with this paper. We always receive comments on the instrumental variable, and I receive very good feedback, especially from Jeffrey on the internet infrastructure. So we would check whether we could be able to look at the internet infrastructure with this georeferenced data on that, because it's a very good I think that internet, because it's a policy and it's definitely an external variable, exogenous variable, so it's worth to explore. And we have the other waves of data, we just need to gather them, and in this respect we will be able to have a time dimension as well, because this is only for 1 year observation at the moment, and hopefully we will be able to expand our work with the upcoming waves and existing waves as well. And there is no difference, I don't think there will be much difference on the georeferenced data, but we will be at least have a time dimension. And regarding the financial inclusion measures, I think it's all because of data availability. So far we have only 3 financial inclusion measures in the household survey data. That's why our study is limited to these 3 measurements of financial inclusion. But apart from that, we can still have the potential to improve paper both in terms of theory and empirical work by disaggregating financial inclusion measures, and also making theory and the results more aligned to give a more fit structure of the paper. Yeah, I think these are all very useful comments where we can take paper to a further stage.
Yeah, thank you, Ayse. And I think I see Hong has added another dimension that if doing that patient to great value added, if you could use some more recent data, especially even if it may be able to integrate the COVID-19 impact, because I see where the data is, but it may capture the COVID-19 impact. And I think that's very useful, that because it brings an interesting dimension. And actually, in both dimensions of the study, both on food security and on a financial inclusion. Actually, I just noted that if you are using georeferenced data, in a recent paper of mine with the Akin Moraquinho from LAFBRA, the editor was very much excited by looking at the map of the georeference area that we did, which you can capture. So if that would be available, that would be because it defines the area of study. And especially given that you have huge amount of data set, the georeference coordinates from the satellite helps pinpoint the exact focus of the study. But thanks indeed, Ayse and your co-author, great work, and we want to wish you the best in extending this work to greater dimensions and do all the robustness testing and finally publication. So please join me in giving a hand of applause to Ayse and Joseph for this exciting work and for sharing it with us at this Center for Global Finance Seminar.
Thank you very much for giving this opportunity to present our results and give really good feedback. Yeah.
Thank you. And next week, we have an interesting presentation from Yusuf Somare, who is a professor of finance at the Financial Laboratory at University of Laval in Canada. Is a paper about financial development and medium, small, micro, small, medium enterprise financing and evidence from financial organizations with a social mission. It's a paper joined with the Desiree Kanga, the International Monetary Fund, IMF, and also with Hubert Chakonte Chigua, who is from the Department of Accounting, Finance and Economics at Cage Business School in France. So the trio will be sharing the work with us next week on Wednesday, same time. And until then, let me wish you a great afternoon, and thank you very much for being part of this presentation. Thank you indeed. Thank you.